Hey everyone, welcome back to Corporate Decoder, the place where we turn corporate jargon into plain English. Today we're diving into NexPoint Residential Trust's latest filing, and trust me, it's more interesting than it sounds, especially if you're into knowing how your rent money is being used. This report is an 8K, which is like an urgent update a company sends to its investors. This one's dated February 25, 2025, so pretty recent. It's like a snapshot of what's been happening with NexPoint, a company that owns and manages apartments. NexPoint Residential Trust, Inc. is the company behind this filing. They're set up in Maryland and are traded on the New York Stock Exchange under the ticker NXRT. Essentially, they're in the business of owning and running apartment complexes, hoping to make money from rent and increasing the value of their properties. Now let's get to the meat of the report: financial results. The company announced their financial results for the fourth quarter, the last 3 months of 2024. It's important because it tells us how well the company is performing, if they are making more money than they spend. This part is just legal language basically saying that the information in the press release which they provided separately is not an official and legally binding filing. It means the company is sharing the news, but the real details are in their official reports filed later. Looking at the exhibits, Exhibit 99.1 is where the actual press release lives. This press release would give a summary of the company's financial performance. Okay, so NexPoint Residential Trust is in the apartment business, right? To understand if they're doing well, we would want to look at a few things. The company is making money. Generally speaking, companies like these make money primarily from leasing apartments to tenants. They're hoping to keep their buildings occupied, charging enough rent to cover their expenses like building maintenance, paying employees, and of course, paying off any debt they've taken out to buy those properties. Since we don't have the detailed financials within this 8K filing, let's imagine what they might look like based on typical reports from similar companies. For example, we would be looking for revenue, which is the total amount of money coming in from rent. We would want to see if it's going up or down compared to previous quarters. An increase would be a good sign, suggesting they are either raising rents or keeping their apartments occupied. Occupancy rates are the percentage of their apartments that are actually occupied by tenants. Higher occupancy is usually better because it means more consistent rental income. Net operating income, sometimes called NOI, represents the revenue from their properties minus operating expenses. Basically how much profit they're making from running their apartments before considering things like interest payments on debt or taxes. This is a key indicator of how efficiently they're managing their properties. Funds from operations, commonly known as FFO, is a metric especially used by real estate companies to measure their performance. It basically adjusts net income to give a clearer picture of their cash flow from operations. Investors use it to evaluate how profitable the company is relative to its assets. We would want to see how NexPoint's numbers compare to other similar apartment rates. Are they outperforming the market or are they lagging behind? This gives us context. We would also want to look at their debt levels. Are they carrying a lot of debt? If so, how easily can they cover those payments with their rental income? This speaks to the company's financial stability. More broadly, trends in the housing market impact NexPoint. For example, is there an oversupply of apartments in the markets where they operate? This could put pressure on their ability to raise rents. Are interest rates rising? This could make it more expensive for them to borrow money for future acquisitions or renovations. Essentially, the better these numbers, the better the company is doing. Now let's wrap up with an overall assessment of NexPoint. Based on this 8K filing and understanding the real estate market, here's a quick take. NexPoint appears to be operating in a competitive market. They're generating revenue from their apartment properties, but their profitability depends on how well they manage their expenses. Their debt levels and their ability to adapt to changing market conditions, such as interest rate hikes or increased competition from new apartment buildings, are key factors to watch. One potential risk would be a significant economic downturn, which could lead to higher vacancy rates as people lose jobs and can't afford rent. Rising interest rates could also squeeze their profits. On the opportunity side, if they can successfully renovate and upgrade their properties, they could potentially increase rents and attract higher quality tenants. They could also look for opportunities to expand into new, growing markets. Overall, NexPoint's performance hinges on their ability to manage costs, maintain high occupancy rates, and strategically navigate the broader economic environment. It will be important to see the detailed financial statements from their official filings to get a clearer picture. Thanks for watching Corporate Decoder. If you found this video insightful, please subscribe, like, and comment. Your support helps us decode more corporate filings for you.